Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Can I get a loan if I'm unemployed? Very common question. Today, we break down the answer. Welcome to the show. We're so glad you're here today. So, if you've been part of corporate downsizing, you might be seeking a loan to help you just kind of restart your economic engine. You might want a business loan to start an entrepreneurial venture, maybe a car loan so you can do some driving side hustles, or a credit card to help cover some expenses while you find a new job. But unfortunately, most lenders prefer borrowers to have stable W-2 income. Well, if you're not working a traditional job, you might find it hard to take out new credit. So here's what you need to know about taking on new debt when you're unemployed. So how do banks figure out your ability to repay a loan? So when banks issue loans, they look at your credit history, income, your assets to figure out if you're likely to repay the loan. Your credit score is extremely important for this because it shows how you've behaved with loans in the past. If you have a high credit score, banks view you as a good credit risk. They're likely to lend you money at a good interest rate. However, banks aren't only concerned about your history, they care about your future too. Will you repay the loan this time? Lenders look at your current income, your current assets, just to figure out whether to issue more credit to you. When you're unemployed, your primary form of income dries up. With little money coming in, banks are less eager to loan you money. You'll need to prove that you have financial assets or the ability to earn money outside of a job to get a loan. People commonly complain that the only people who can get a loan are the people who don't need it. Well, actually, that's kind of true. If you have a steady income and you always pay your bills on time, you probably don't need a loan. But banks will trip over themselves to lend you money. Interesting, isn't it? On the other hand, if you have erratic income and have struggled with debt, few banks will lend you money. When you're unemployed, banks don't usually think you can repay a loan. They are unlikely to issue a new loan to you. What type of income verification do I have to provide to get this loan? Banks who issue credit have the right to request information about your income and assets and to require certain forms of documentation to verify that income. Even if a bank doesn't ask for verification, you need to answer the questions about your income truthfully based on your current circumstances. If you don't answer truthfully, you could be committing fraud. So, let's explain the common types of income verification documents by loan type. First, credit cards. So credit card applications typically ask about your annual household income. If your spouse is still working and you worked for part of the year, you can write down your expected income for the year. The key is to be truthful based on realistic expectations. Unless you have a job offer in hand, don't count on future income from a job. If you're single and your only income is from unemployment, then that should be your expected income. Personal loans. So they are a form of installment loan that does not require collateral. Lenders typically want to see prior tax returns for self-employed people or 2 recent pay stubs for traditionally employed people. Unless you have self-employed income, you probably won't qualify for a personal loan during unemployment. A possible exception to this is the buy now, pay later installment loan, such as those offered by Klarna or Afterpay. But payments on those loans start just 1 month after purchase and can come with interest and penalties if you miss a single payment, even during unemployment. We don't recommend these payment plans. Car loans. So income documentation requirements vary from auto lender to auto lender. Some require 2 recent pay stubs or 2 years of tax returns for self-employed people. Others just ask for a household income number. Whether documentation is required, you must answer questions about employment and income truthfully. Most car lenders want to see a debt-to-income ratio below 36% to issue a loan. If your income has dropped too much, you may not qualify for a loan based on your lack of income. Mortgages. All right, so mortgage loans come with the most rigorous documentation requirements. You might be approved for a loan with a job offer letter, but your lender will likely want to see a pay stub before the mortgage is issued. If you have a lot of financial assets, You may qualify for a mortgage just based on your assets rather than your income. However, your liquid assets, like money in a brokerage account, must be documented. This would be the most important question to ask. How should I use credit during unemployment? Getting some new credit when you're unemployed is a challenge for sure, but you may also need to consider how you'll use the credit you have during unemployment when money is tight. Making smart choices now can help you keep your credit and your finances intact. While cutting unnecessary expenses and, of course, hustling to keep income coming in are obvious action items during unemployment, these actions may not feel so obvious. Adjust your income for income-driven repayment plans. With federal student loan repayments set to resume, student loan borrowers need to think about their loans again. If you're laid off, getting on an income-driven repayment plan might be the smartest thing you can do. When you recertify your income at a level that reflects your unemployment, your monthly payment may be close to $0 per month until you get a new job. And then the next thing you can do is make a minimum payments on other debts if you can. If you have a mortgage or a car loan, you're going to want to keep making payments on that debt so you can continue living in your house and, of course, driving to get job interviews. Now, if these payments are too burdensome, renting your car using Turo or Hire Car, hire with a Y, Hyre, car, or taking in renters for a period of time. Becoming a temporary house hacker during unemployment could be a great way to stay afloat during this trying time. You can find out a whole lot more about house hacking at thecollegeinvestor.com. While aggressively paying off debt won't happen during unemployment, try to make minimum payments on your credit cards every month. This will allow your credit score to stay high. Use a low interest rate credit card if you have one. If you have to borrow money to stay afloat, use a low interest credit card. Keep expenses to a minimum and work to repay the card before a high interest hits after the promotional phase runs out. And then try to build an income stream without additional debt. This is huge. Recessions and unemployment often lead to disruptive innovation. If you're excited to start a new business, try to start the business without taking on debt. Once you have a customer base and income, you'll qualify for a business loan at a better rate. And one more idea, seek help instead of money from family and friends. Borrowing money from friends and family could lead to souring relationships. Instead of asking for money, see if your friends and family could help you in other ways. Perhaps you can move in with your parents for a few months while you land back on your feet. Or you could drive a friend's child to daycare in exchange for using her car for the day so you can get to interviews. This kind of social safety net can get people to rally behind your job searching efforts instead of leading to bitterness that you don't have the money to pay them back. Can I get a loan if I'm unemployed? Well, the short answer is that getting a loan is difficult when you're unemployed. If you do have assets, a partner with a stable income, or a self-employed income, then you might qualify for a loan. But taking out new debt is less important than managing existing debt when you're unemployed. If you're careful to make minimum payments on all your debts, you can get through unemployment with your credit score intact. Your major financial goals may be delayed a bit, but with your new income, you'll have the ability to get back on track. And that is our show for today. I hope it was encouraging and helpful to you. If it was, go ahead and subscribe to this podcast. Tell your friends about it. You can also follow us all over social media. We're everywhere you are. Just type in The College Investor and you'll find us. Also, check out thecollegeinvestor.com right inside this article for more links and resources that we mentioned that you can check out as well. Thanks again for stopping by today, and we'll talk to you again real soon.